Rate hikes have kept people in the economy and markets nervous. Markets have been bumpy as a result, but there may be a bond boost on the horizon to help portfolios. There are things that people can do to stay focused in the long run to reduce nervousness about that. There are ways to avoid using low rate cash vehicles for cash savings you have on the side. We'll cover that and more today in Quarterly Context for WealthStep. Welcome to WealthStep Quarterly Context webinar for the third quarter of 2023. WealthStep is an online financial guide to help 401k plan participants and other individuals make smart decisions about how much money they need to retire and how much to save and how to invest now to get there. These webinars are designed to make economic and other information approachable, high-level perspective regarding the economy, markets, and investor behavior patterns to help you stay more relaxed by staying informed and make better decisions towards your goals. We try to keep these presentations to about 15 to 20 minutes, and recordings will be on the blog at wealthstep.com. Please pass it on to other people that you care about to help them achieve retirement readiness. WealthStep, what is it? It's online information, and in the future we'll be launching online advice for 401k plans and individuals who typically do not have an individual advisor and in some cases don't have a retirement plan. The focus is on three main things: aim, save, and invest, all of which is designed so that you can spend appropriately in retirement and live the life you want to live. So we have two segments as always. One is the general perspective, and then a quick review of smart financial independence decision concepts and resources. As always, we encourage people to think about their short-term and long-term goals, what you need versus what you'd like to have, and then focus on the things that matter that are also things you can control. You can't control markets, you can't control the economy, you can control how much you save, what you spend, and how you invest consistent with your life stage rather than being, for example, an emotional investor. So let's get into part one. The market is always a little bit bumpy, and that oftentimes is the market responding to different news items. That's normal. Don't worry too much about what you hear in the news in the short run. Sometimes that has a short-term effect, but in the long run, the news and markets smooth themselves out. There have been a lot of rate hikes in the last year and a half plus, and that has caused bonds to drop. When rates go up, it causes bond prices to go down because existing bonds on the market have lower rates than the new bonds that are coming on the market. So the market responds accordingly. We'll talk later about how there should be and will be a reduction in rates in the future, and that can actually give a boost to bonds. So there's an upside to that as well. Inflation has remained on an improving basis, has fallen a little bit further versus the 9% return or inflation level of the end of 2022. Stocks and bonds were both negative in the third quarter, given the uncertainty and concern about rates possibly going up. However, just today, October 19th, the Fed announced that they will be putting a pause on rates in terms of increasing. So it's likely that markets in the near future will respond a little more positively, and it could take some nervousness away from markets. Unemployment has remained at near all-time lows, around 3.8%. Versus prior quarter of 3.6, up a little bit, but not much. And GDP, or gross domestic product, numbers have been 2.1 and 2.2 for the first and second quarter, and the expectation for the final numbers of the third quarter is almost 5%. So that's a big jump in terms of projected growth, and suggests that there is some strength in the economy on the horizon. So some mixed numbers, mixed messages and mixed numbers hearing out there, which is what makes markets a little bit nervous sometimes. Overall markets for the quarter, because of those mixed messages, the third quarter were down both in stocks and bonds. But if you look at the year, 5-year and 10-year, numbers are quite strong. If you look at bonds, however, a little bit weak because we went through a around a 10-year period where rates were lower than they ever were, so bonds were producing low returns. But these returns also reflect the recent numbers, and once bond rates start coming down, the long-term numbers will boost back up a little bit too. So, but just important to remember that even though something could be bumpy in the short run, the long-run numbers are what really matter and are what reward you for that short-term risk if you stay involved as a disciplined investor. Another way to look at that, similarly, different segments for 10-year numbers across small companies, mid companies, large companies, and what we call value, core or blend and growth. Different investment styles within the stock market have had different return levels, all fairly solid over longer time periods. And that's a valuable reminder relative to short-term bumpiness. Even in the last year, within the same categories, some returns are stronger than others, and those different asset classes take turns being strong, and that's why you diversify, so that you always capture what's at the top and never get too much of what's at the bottom. Overall, if we take a look at the 4 worst markets in history and their recoveries, the current market after the global financial crisis, the COVID rate dip, and the rate dip, interest rate caused dip, is still on an inflation-adjusted basis ahead of the Great Depression, the 70s oil and financial crisis, and the dot-com bust. So sometimes helpful to see that kind of good news, that even though things are a little bumpy right now, still far ahead of the game versus other bad markets. Will there be a recession? Some are still thinking there'll be a soft landing. Others think that some kind of recession is still possible, given that inflation is still a little bit elevated. Student loan payments are resuming beginning again in November, and that takes money away from people that could otherwise be spent and to stimulate the economy. That would lead to a less of a soft landing if that's what materializes. Gas prices being higher also has that effect, but gas tends to be volatile and can go up and down. Overall, economists, the number of economists that think there'll be a recession has gone down a little bit. So that's still to be determined. So it's too soon to say, but so far it looks like not a dramatic downturn expected. Inflation has continued to come down, which is what the Fed wants to see, and that if it comes down further and then stays down, that's when the Fed would start lowering rates, which would give a boost to bonds, and the Fed would do that sooner as well if it turns out the economy is cooling, to help stimulate the economy. You see gas prices or oil prices here, which affect gas prices, are up a little bit. Those rates we're talking about, as they come down, as the Fed brings rates down, that could give bonds a boost. We'll talk about that in a second. And what the Fed is talking about now, however, is having rates be at an elevated level for a little bit longer period than previously expected before they start coming down. Here's how rates and bonds work. When rates go up, bond prices fall for the reason I mentioned before. There's a term called duration, which is a little bit a mathematical interest rate sensitivity term, and it's measured in years, which is not the same thing as bond maturity in years, but you can think of them roughly conceptually as being longer bonds versus shorter bonds relates to duration as well. So here's how this works. For a given 1% change in rates, bond prices will shift more or less depending on whether they are shorter term or more intermediate term, and long-term bonds aren't even shown on this chart. It would be a bigger arrow down or up in this case over here. So if there was a 1% increase in rates, which there was a couple of times in the last 15 months incrementally, a shorter term bond portfolio might drop 2%. A sort of medium term portfolio might drop 4%, and an intermediate term portfolio might drop 6%, just with a 1% rate. Now, the reverse is true when rates start to drop, which they eventually will. When instead of going down 6%, if rates come down instead of up 1%, then bonds with a duration of 6 years would expect it to go up 6%. So that would be a nice bond boost. And so hang in there if you've been nervous or disappointed in bonds. This is a very unusual time where stocks and bonds have gone down together, but it's really driven by that really rapid increase in interest rates over the last 15 months. So if bonds fall 2.7% as the Fed expects over the next 3 years, bonds would go up about 16%. So there's going to be a reward eventually for patience with bonds, and then bonds are more likely to act as they normally do, as more of a cushion when markets are bumpy. But bonds have always been a little volatile, just not as volatile as stocks in the long run. On an indirectly related note, given that rates are higher currently, that means that some short-term cash type vehicles or short-term bonds have been paying higher rates, except savings, checking, and what are called sweep vehicles inside brokerage accounts, which are paying near 0%. So if you think you're getting paid more because rates are up, you might be wrong. And if it's not money that you need to spend anytime soon, you might want to consider, but you might need it more in the medium term. If it's long-term money, probably should put it in your long-term portfolio. If it's medium-term money that you're going to be spending somewhere on the horizon in the next 3 to 5 years, or for example, it might make sense to, or would definitely make sense to move it into something like a money market fund instead of paying sweep rates or savings or checking rates of 0%. But of course, if you need it immediately, you need it in your checking so that you can write a check and cash that check. Short-term bonds are another option, but not quite as simple as a money market fund. CDs, some people find attractive, have a little bit of a rate premium versus money markets, for example, but they have penalties if you withdraw early from the CD. So there's a liquidity penalty. So a couple things to consider. Overall, savings rates have come down after the COVID period, where people spent less, and during the time where there were stimulus payments to individuals, many individuals around the country. So that's something that you might be aware of and feeling. And credit card use is going up, so that's making some analysts and some investors nervous because it makes the market feel like there's a little bit less resilience and reserves for the average person if things get tougher. Overall, consumer sentiment has been an upward trend, but cooled just a little bit, and but still overall below average relative to long-term history in terms of consumer confidence. So want to thank you very much for joining today. We appreciate you being here. That is the quarterly context general section. Now we're going to jump into part 2, which relates to a review of retirement planning concepts. So if you're already 100% on top of that, you may want to skip this next section, but it can be a great quick review as a reminder to how to stay on track and get on track. And of course, you can go to wealthstep.com/blog for additional information. So there is a video on WealthStep.com blog that will go into a broader presentation related to the topics today. But let's get started on some quick review. So there's 3 key elements to becoming retirement ready. One is knowing your goal, having a rough sense of how much you're going to need in the future so you can make sure to save enough to get there. And a general rule of thumb, if you're not sure, is to save 10 to 15%. If you haven't saved much and you're more in the middle of your life, then you may need to save a lot more than that to catch up. But if you have been saving consistently at reasonable levels, or if you're at the much younger end of the spectrum, 10 to 15% is often, if you're not sure, that's a good starting point, and then you can refine from there. But don't wait 5, 10 years and say, oh, I'll figure it out later. It's better to get started now and then realize you can start to save less than to try to catch up, which is much more painful. And then the investing part should be relatively simple if you have investment vehicles in your 401k plan or an investment program that it helps you determine a stock bond mix and a pre-built portfolio that's designed for your life stage so that you can have that be managed appropriately while you're really focusing on the savings element. What we see sometimes, sadly, is that people at the younger end of the spectrum push off the decision. People at the other end of the spectrum wish they had not pushed off their decisions earlier and find it challenging to catch up if they are far behind relative to their needs and may end up having to work harder and longer than they hoped. So getting on top of the savings and investing decisions wisely is a key factor in improving long-term quality of life and reducing stress. In the long view, stocks do better than bonds, but they're bumpier along the way, as you can see here. Some pretty much more volatility on average, but that's part of the price that people pay to get higher returns. Most people should have some mix of stocks and bonds, however, over most of their lives. However, some people might want to have 100% stocks in their earlier years when their spending years are much farther away and they can tolerate some big bumps along the way. So it's important to think about your life stage when you invest. It's also important to think by life stage, because then you will know that you are in a portfolio that makes sense for your life stage, and that can help you reduce emotional reactions to difficult markets, and it helps you stay disciplined in your investing to stick with the portfolio that makes sense for your life stage. Studies show that people who just participated in the market and didn't make changes end up having much better returns in the long run than people who get in and out of the market out of concern or nervousness or market timing. So while it feels sometimes like the right thing to do to take action, if you have a portfolio that's the right stage for the right stage of life, much more often than not in the long run, it makes sense to stick with that, and then only change the portfolio when you enter a different life stage where is a different fit. We'll talk about if you are using target date funds in a retirement plan, that's done automatically for you. If it's what we call target allocation funds, which don't automatically change, you would need to make the change with each life step. So once WealthStep launches its advice tools, this is what part of it will look like on the inside. Planning tools, an investment advice tool, which really is primarily focused on helping you find the fit relative to your life stage, and then education videos and some reminders to help you stay on track. WealthStep will have different levels of access for 401k plans. That's where the company covers the cost. WealthStep Direct for smaller investors who want a portfolio managed for them but still want the online advice. So a digital only, where there's no portfolio management, but people would pay an annual fee to access the planning advice tools. And then there will also be a general public tool, which will be free, but does not include the advanced advice. This is part of our goal of helping improve financial literacy and retirement readiness globally, our give back to the broader community. So with that said, aim, save, invest, spend, do all that wisely. Remember the key ideas around using the right risks. You want to fight inflation by having a long-term portfolio that beats inflation and that helps you avoid longevity risk. That longevity risk is the risk of outliving your money. So remember that some market volatility is that price to pay for those longer returns, and know that if you have no volatility, you would probably be in something so short-term like cash that would be eaten up by inflation or beat by inflation over time, which ends up actually being much more damaging to your goals than having some volatility along the way. So thank you for being here. We appreciate your time, and we wish you the best of luck.